What is the common denominator to the meme stock frenzy that we're seeing right now?
Well, it's that they're all terrible businesses that aren't trading on fundamentals and are all, across Wall Street Bets forums, across Reddit that people are talking about. And it's an effort to get rich quick, to capitalize on these really big swings in these companies. This is stretching into second day today with all of these companies that you mentioned, GoPro, Krispy Kreme, Wendy's, amateur traders piling in once again. This comes, of course, at a time of broader market euphoria with stocks trading at record highs. So it's unsurprising that these animal spirits are kind of moving into more speculative quarters of the market. JP Morgan's trading desk this morning actually flagged that its internal basket of meme stocks is up 7.9% month to date versus the S&P 500, which is up 1.7%. So really a testament to this euphoria that is once again back in markets. And if you look at Kohl's yesterday, that was at the forefront of all of this. It has a float of 48% rather. This is according to data from S3 Partners, meaning that these are, bets against the company. By comparison, GameStop has a float interest of 20%. So really
short
a testament.
interest.
Exactly.
Yeah. Is this exactly like what we were seeing in 2021? I don't remember that far back, but I'm sure you've done the reporting. So what's the difference between now and then?
So the enthusiasm is really similar, but the backdrop in markets is really different. Obviously, at the time in 2021, traders were, their finances were being propped up by stimulus checks. We were at zero interest rates. There was so much enthusiasm in markets. And this time around, there's a lot of uncertainty around the macroeconomic outlook. Interest rates are elevated with the Fed saying they won't cut anytime soon. We have trade uncertainty, so less favorable backdrop for this risk taking, but also interestingly more investment products that cater to this type of enthusiasm. Wall Street's casino has so many options. You have levered ETFs, you have all these companies, you have so many crypto investment options.
I have to say it's wild. I think back to 2021 and what an interesting time it was. But when we would have these conversations, it was all, the conversation was very much, this is a product of ZIRP. This is because we have interest rates at zero, that once we raise rates up, that'll sort of drain all of this out of the market. That obviously has not happened.
Yet.
The
president is screaming for another 3 percentage points to be cut.
I know. And
that gets us close. It's NERP.
Well, that's the thing. You have to wonder, will that just, if we're having this sort of activity when we're at 4.5% or close to it, what happens if we go back down to 1%? I shudder to think. But let's talk about how people, normal people, not retail traders who are sort of jockeying around on Wall Street Bets, how do you position around some of the mechanics of what's going on with the meme stocks?
So Barclays head of derivatives, Stefano Pasquale, has actually been flagging this frothiness for the entire summer pretty much. And he says that a way to hedge this euphoria is to use a popular hedge fund strategy called a dispersion trade, where you bet on single stock options and also contracts on broader indexes like the S&P 500. Basically, you're betting that a basket of meme stocks will be more volatile than the S&P 500. But also, alternatively, if you want to take a more directional bet, you can just buy puts on these meme stocks. I don't know if that will pay off quite well given how they're doing. But he also flags one important point is that even though we are seeing this euphoria in these speculative names, it's not necessarily an indication of something nefarious for the broader market.